Okay, let's go ahead and get started. Hello, everybody. Welcome to the part 4 of the Quarters Theory webinar. We've done several parts before, and I believe this is going to be our last one for 2010. I appreciate you joining me today. Thank you again for the great introduction and a great webinar from Mr. Ed Ponzi earlier. Thank you to our friends at FXStreet.com for organizing this webinar. My name is Ilian Yotov, and perhaps many of you are familiar with my name as the creator of the Quarters Theory method. I'm also the founder of a couple of financial websites, allthingsforex.com and tradertape.com, and a host of the popular daily All Things Forex broadcast, which you're welcome to listen to Monday through Friday from 1 to 2 p.m. Eastern Time every week. What we're going to discuss in the webinar today is some of the trend and price behavior analysis methods of the Quarters Theory. So what I'm going to do is I'm going to take a look at 3 or even 4 major currency pairs: Euro dollar, pound dollar, dollar yen, and also the Aussie against the US dollar. And we will try to recognize some patterns and some signs of strength or weakness in the price behavior of these major currencies by applying the methodologies of the Quarters Theory, and then ultimately you will see for yourself how a currency trader could benefit from these developments. One of our attendees is asking, are these webinars available on my DVD? I haven't got a DVD yet, but you can actually learn more about the Quarters Theory if you purchase the book, which is out, and you can. It was published in January of this year, and you can purchase it at my website, allthingsforex.com, traderslibrary.com, amazon.com, or your local Barnes & Noble and Borders bookstores if you live here in the United States. So let's go ahead and get started with the euro-dollar pair. Those of you who are not familiar with my Quarters Theory, let me give you some of the basics. With my Quarters Theory, basically, I look at what I call the major whole numbers, such as, let's say, for example, the euro-dollar exchange rate. You have 2 major whole numbers between $1.30 and $1.40. $1.40 has been the type of a price level that the euro-dollar pair has been attempting to climb above, and every time it has managed to push above $1.40, it has been denied what I call a transition into a new 1,000 pip range, or the 1,000 pip range between $1.40 and $1.50. Every time the euro has done that, and it's been about, 5 or 6 times already, that the euro-dollar pair has had some serious problems with transitioning into the $1.40s. And every time it has been denied, it has been pushed back into the preceding 1,000 pip range, which is the $1.30s, or the 1,000 pip range between $1.30 and $1.40. Of course, those are distances, never changing, constant ranges of exactly 10 cents, or in terms of pips or price interest points, that of course is 1,000 pips. So with the Quarters Theory, what I do is I divide these 1,000 pip ranges into 4 equal parts, or 4 large quarters of 250 pips each. And then I propose that currency exchange rates and prices in general do not actually move in a random manner, that there is no chaos and lack of organization, but rather the opposite. With the Quarters Theory, I propose that prices move in terms of quarters, in systematic efforts to complete these large quarters of 250 pips each, and then ultimately in a systematic effort to complete the entire 1,000 pip ranges. So from the Quarters Theory perspective, I consider every significant price move to occur from one large quarter point targeting another large quarter point. And this way you always know, a Quarters Theory trader always know what is the starting point of a price move and always knows what's the ending point of a price move. Because if a large quarter is successfully completed, obviously prices would go from one large quarter point to the targeted large quarter point. If the large quarter is not successfully completed, then we get to see a reversal that takes prices back to the preceding large quarter point. And so the quarters theory basically puts these price fluctuations in a systematic order, if you will. So let's take a look, for example, at the latest developments with the euro-dollar exchange rate from the perspective of the quarters theory. Here we have the euro-dollar exchange rate basically flattening, which is perfectly normal ahead of a very important economic news or any kind of event or announcement from a major central bank. This here is the period about a day or so ahead of the Fed's interest rate announcement, which was last Wednesday, November 3rd. And if you note, all of the price action here occurs around a very important major large quarter point, which is the $1.40 level. Of course, this is the price level, which I call major whole number and a major large quarter point in the quarters theory methodology, because it's such an important junction that marks the end of the previous 1,000 pip range between $1.30 and $1.40, and at the same time, it marks the beginning of a brand new 1,000 pip range between $1.40 and $1.50. Because of the importance of these major large quarter points, they tend to attract prices, and a lot of traders also call them the so-called psychological levels, obviously. So the euro-dollar pair, before the Fed's announcement, has made several attempts to move above $1.40 and make that transition into the $1.40s from the $1.30s. But it has been denied. It's been pushed back. And now, ahead of the Fed's announcement, we're seeing another attempt. These lines that you're seeing here, the dotted lines, are the previous resistance levels, by the way, which were around $1.41.5 or so, and then you have $1.40.80, an area between $1.40.50 and $1.40.80. That were a couple of resistance levels along the way. Every trader should also consider where prices, what type of a large quarter, which large quarter will prices be more likely to start working on. And I did a webinar, and on my All Things Forex broadcast, I also discussed the two scenarios that we can anticipate and prepare for ahead of the Fed's interest rate announcement. The first one was what I call the shock and awe scenario, and the second scenario was the so-called measured approach scenario. The first shock and awe scenario was the Fed going with over $500 billion of additional quantitative easing, and up to $1 trillion. Actually, if I'm not mistaken, Goldman Sachs was even forecasting more than $1 trillion, up to $2 trillion that the Fed might throw in. But the general perception was that if the Fed goes with a larger than $500 billion additional treasury bond purchases, then that would be a more aggressive type of scenario than the opposite, which was the so-called measured approach, as Wall Street Journal called it, which would have been treasury purchases of, let's say, $100 billion, which is definitely not that massive of an amount. So the two scenarios that we were prepared for is if the Fed goes with the shock and awe scenario, then the dollar weakens additionally, and this could possibly serve as a catalyst for the euro to challenge these resistance levels, $1.40.80, $1.41.5 area, and then ultimately break above them. And if it breaks above them, then that creates an opportunity for what I call a completion of a large quarter or a large quarter move, which would start from the large quarter point of $1.40 and potentially target the large quarter point above $1.40, which is $1.4250. This is obviously a very important large quarter because it's the first large quarter of the new 1,000 pip range. And in the aftermath of the Fed's announcement, if you see this candle here, this is, by the way, a 60-minute chart of the euro-dollar pair. you can see the market's reaction. The euro spikes up, pulls back a little bit, but slowly but surely in the hours after that continues to grind higher, breaks decisively above these resistance levels, and it goes to do, surprise, surprise, a challenge of the large quarter point at $1.4250. Of course, when I say the word surprise, I'm being facetious because every currency trader who is familiar with my quarters theory would know that the next logical price point that the markets could target is the large quarter point at $1.4250, especially if decisive move above $1.40 happens and the euro-dollar pair breaks above $1.41 to 7 or 59 resistance level, which the euro-dollar pair did. And it reached the large quarter point at $1.4250. Moreover, it even made an attempt to work on the next large quarter of 250 pips, which would have been the quarter between $1.4250 and $1.45. But what I wanted to talk about today is how a trader could recognize some signs of what I call unsuccessful transition into a new large quarter. And a very helpful tool for that is a tool that I designed, and I call it the hesitation zone. The hesitation zone is the range of the first 75 pips, or 3 small quarters of 25 pips each. Because just as you can divide the 1,000 pip ranges into 4 equal parts, you can also divide the range of 100 pips between 2 whole numbers. For example, the 2 whole numbers between $1.40 and $1.41, or $1.42 and $1.43. Those 100 pip ranges, we all use the decimal numeral system obviously, can be divided into 4 equal parts, or 4 what I call small quarters of 25 pips. And it's very important for a trader who utilizes the quarters theory methodologies to pay attention to price behavior when prices attempt to enter a new large quarter. Because the first area that they enter is the area of 3 small quarters of 75 pips above or below a large quarter point, which I call the hesitation zone. And the name should say it all. Prices do often hesitate within that area. And in a recent example with the euro-dollar pair, and later on I will show you different numerical representation of the large quarter points, the hesitation zone, and so forth, with the pound-dollar pair. But essentially, the price behavior and the price levels and the ranges were very identical to what I'm showing you now with the euro-dollar pair. So we'll see that in a couple of minutes. So it's very important for a trader to recognize some signs of possible exhaustion or that could lead to a reversal, and signs that the transition into a new large quarter may not be as successful. And ultimately, as a result of that, we can anticipate prices to fall back into their previous large quarter and then begin to work, instead of on a quarter, in a euro-dollar example, instead of working on a quarter between $1.4250, when they hesitate within that hesitation zone and they reverse and then encounter resistance at the large quarter point, then prices, we can begin to prepare for a move in a quarter in the opposite direction, between $1.4250 and $1.40. So, well, Gino is asking a question, with the euro's volatility 180 pips per day, don't you think, he says, or she says that 75 pips is too small for the hesitations? Well, if you pick up my book, you will also find out, and later on in this presentation, you also see other important price levels within the large quarters. And you will see that besides the hesitation zone and the point that marks the end of the hesitation zone, which in the euro-dollar example here would have been $1.4325, we also have the half point of the large quarter, and then we also have another important price level, which is the whole number preceding a large quarter point, which I'll discuss in a few minutes. But if you pick up the book also, that will give you a lot more details about the reasoning why the hesitation zone is 75 pips Why is it not 25 pips? Why is it not 50 or 100 or 200 pips? Okay. The reason also why I decided to designate this hesitation zone is because of these whole numbers that in this particular quarter example, you can see how close the whole number at the $1.43 is to the actual large quarter point at the $1.4250. It is only 50 pips above it. Within the hesitation zone, there's also another small area of 25 pips, which I call the overshoot area, which is in part of the hesitation zone. But, and I also explain in the book, if prices just overshoot a large quarter point and do not move more than 25 pips, then that indicates that the move is not a decisive breakout above a large quarter point or below it if prices were moving lower. And that's what I call just an overshoot and not a decisive breakout. And that could be also one of the early warning signs that the transition into the new large quarter is not very decisive, and then the prices could fall into the previous large quarter and ultimately also begin to work on the quarter, which is the inverse quarter. They have completed with the euro-dollar example because of the Fed's announcement. It gave the catalyst for the completion of the quarter between $1.40 and the $1.4250. It even, on some inertia after that strong move to the outside, prices moved a little bit above $1.4250. They reached as high as $1.4281, if I'm not mistaken. But then they quickly started faltering. We encountered resistance just ahead of that whole number at the $1.43. Obviously, the whole numbers are important price levels. They do tend to attract a lot of traders to pay attention to them, and they could be challenged, these whole numbers. But as long as prices remain within the hesitation zone and do not enter it decisively and do not break outside of it, then we could still recognize at that point the signs that the new large quarter transition is not very decisive, doesn't have a lot of strength into that move. And then we can anticipate a possible reversal, which in a euro-dollar pair materializes in a way that prices go a little bit above the large quarter point at the $1.4250, reach as high as $1.4281, come short of the whole number at the $1.43, which in itself also is a psychological decisiveness. Great question. How do you determine decisiveness? Like I said, that area here of one small quarter, again, I don't call it the quarters theory for nothing, right? So you have to pay attention to these large and small quarters. The overshoot area above a large quarter point is 25 pips. If prices stay and move above that $1.4250 area by less than 25 pips, that's what I call an overshoot. Now, in this case, they moved a little bit higher to $1.4281. So the overshoot area would have ended at the $1.4275, one small quarter, or 25 pips above $1.4250. So they moved a little bit higher. But generally speaking, a more decisive move, and that's why I love this question. Decisive move is a move that targets at least the end of the hesitation zone, which in this case would have been $1.4325. Okay? A move of 25 pips, or how many pips is it? 31 pips to $1.4281. That is not the kind of a move that targets the end of the hesitation zone, which could be the first sign that we have a more decisive attempt for prices to transition into the new quarter. You have a lot more, a sign of more strength. And I will show you with in a minute ahead, some examples as to how we can recognize these signs of strength. The euro-dollar pair did not show you that in a move above $1.4250, but I'll show you some examples later as to how we could recognize the more decisive entrance into a new large quarter, which is a sign of strength. In this case, that was a sign of weakness. So what happens is, as a result of unsuccessful transition into a new large quarter, prices exhaust within the hesitation zone, and they reverse back to the large quarter point. If they fall and break below the large quarter point at the $1.4250, that is not a time is also a factor. Great question. Time is a factor. I explained that in a book. may not have a lot of time to discuss. I have created what I call the 3-day rule of the quarters theory. The time definitely is a factor. As a matter of fact, it serves you also, as I explain in the book, as a time stop. A lot of you are familiar with placing physical stops at particular levels to manage risks, to prevent yourself from when a trade turns against you. But I have also created a time stop methodology with the quarters theory. Excellent question. Let me go back to explaining the price behavior of the euro-dollar pair through the methodologies of the quarters theory. So when they enter a new quarter, don't exit the hesitation zone. Prices can reverse back to the preceding large quarter point. If they stay above it, then that's a sign of strength. But that was not the case with the euro-dollar pair. Prices broke below $1.4250, and they made a move over here to below $1.42, which is towards the end of the hesitation zone, this time below $1.4250. The positioning, this is the 60-minute chart, by the way, of the euro-dollar pair. Someone's asking, just came to the room. Welcome aboard. This is the hesitation zone. The hesitation zone is a range of 75 pips, either above or below a large quarter point. If prices are moving above a large quarter point, then we pay attention to the hesitation zone above that large quarter point. If prices break below a large quarter point, then we pay attention to the 75 pips hesitation zone below it. And I will show you the dual hesitation zone play that we witnessed in recent days with the pound-dollar pair in just a few minutes. So then the prices reverse, move to the large quarter point, to the end of the hesitation zone below $1.4250, and then on any pullbacks, move back to $1.4250, and then it ultimately we had further progression in that large quarter, and ultimately leading to the completion of the large quarter below $1.4250 and $1.40. Just an example there, practical, real-life example in the last few days, is to how a trader could have prepared themselves as to what may be coming in the near future and take advantage, obviously, of these large quarter moves. By the way, I'm getting an email from a long-time student of mine. Len, great to see you. I hope you're doing well, and thank you for the kind words. I appreciate it. Great to hear from you. Thank you for joining us today. Ultimately, in the days to follow, the euro-dollar weakness with, of course, the Fed behind us, the non-farm payrolls behind us. And if you pay attention to my weekly column, the Trading Week, by the way, which I publish on my website, and about other 10 or 12 even other financial websites, including fx3.com, every Friday or Saturday, I will publish an outlook for the new Trading Week. And let me read to you what I wrote last Wednesday or Thursday when I wrote the article before I published it. Okay. I basically spoke in that outlook for the Trading Week this week. And I said, quote, let's see here. With the Fed's interest rate announcement, I'm quoting from the article. Quote, with the Fed's interest rate announcement and the U.S. employment report in the rearview mirror, the week ahead will see the focus shifting on economic activity and growth in the Eurozone, the United Kingdom, and China. And what are we witnessing throughout this week? The focus shifting from the U.S. with the Fed's quantitative easing expectations and announcement being the main theme of the currency markets in recent months. Now the focus all of a sudden shifted to the debt issues in the Eurozone. And if a trader pays attention to these fundamentals, the reason why I'm mentioning all this is that if a trader combines the methodologies of the quarters theory with any other technical analysis that you may be utilizing, but also combines this with fundamental analysis, you'll have a very powerful combination that you can prepare yourself and be able to predict better with a greater probability of success as to what may be next. Because if the European debt concerns were to resurface as they have, then obviously the euro-dollar pair is going to continue to falter with these transitions above $1.40, and then we could see an opportunity, which I also discussed in recent weeks, for the euro to correct some of its gains since August. Because if you paid attention since August, when the market started aggressively pricing in the expectations for the Fed to provide that additional debasement of the US dollar, the so-called quantitative easing number 2, the euro's been gaining against the US dollar since August almost 1,700 pips. So if the focus of the market were to shift from the US to other areas, such as the Eurozone, and the debt problems there, then we could see a possible larger price corrections, a larger price correction of the US dollar's losses versus the euro in the last several months. And that's exactly what we're seeing underway, by the way, in recent days. So back to quickly to answer some questions. Can FX3 type in the links? Oh, well, I actually publish a lot of things there. My daily program I publish there. My weekly outlook, the trading week, is published there every Friday or Saturday morning. So make sure to be on the lookout there, as well as my website, allthingsforex.com. Good question also is coming from Durando, saying, are the quarters always on numbers like $1.25, $1.50, or you have to find quarters for specific currency? Great question. You don't have to find quarters for specific currency. It is based on the base 10 numeral system of our world, and that is the beauty of the quarters theory, because it gives you constant, never changing, constant price ranges. And no matter what currency pair you're looking at, of course, the numbers of the large quarters will be different based on different exchange rates, but the range is the same. It's always 250 pips. 1,000 pip ranges are always 1,000 pip ranges. And the price levels within the large quarters are also constant as well. So they're very reliable, constant price levels. So with the euro-dollar larger correction of its 1,700 pip gains, and I heard Ed discussing some Fibonacci retracement levels earlier, and I have to say, yes, during price corrections, Fibonacci retracements are a very helpful tool to a lot of traders, that we can basically determine, at least within a close proximity of a price level, what price levels may be challenged during such corrections. And about $1.36 or even $1.35 area is the area of approximate 50%, what a lot of traders call the so-called perfect 50% trades on 1,700 pips, with the euro's gains against the US dollar from $1.2588 in August to $1.4281 just last week. So then the euro-dollar pair goes not only to complete the quarter between $1.4250 to $1.40, but also another large quarter that was completed as of, was it yesterday? With the euro dropping below the large quarter point of the $1.40 and moving to, surprise, surprise, the large quarter point at the $1.3750, which below that level we also, of course, had major level of support. A few weeks ahead of the Fed's interest rate announcement, you would recall, the euro-dollar pair was trading within a range between roughly $1.37, with the low at the $1.3697, to the recent highs at the $1.4157 or 59, if I'm not mistaken. So now, just below the $1.3750 large quarter point, we had the support that was tested yesterday, and by the way, was broken below, and continues to, if I'm not mistaken, the euro-dollar pair, I don't have live data in front of me right now, but if I'm not mistaken, just a few minutes ago, looking at the euro-dollar pair, was still at below $1.37. Okay, so let's take a closer look at that next large quarter that was completed. Not only the quarter below $1.4250 to $1.40, but also the euro-dollar behavior when it entered the new large quarter between $1.40 on its way to potentially target the large quarter point at the $1.3750. As usual, the first area that prices enter within a new large quarter is the hesitation zone. Here's your large quarter point at $1.40. Prices break below it. Look at this candle here, move to the end of the hesitation zone, even overshoot a little bit below that level. Now prices, it's important to note here, prices are moving below $1.40, the large quarter point. So the hesitation zone is determined based on the direction of the price move. In this instance, prices are moving below $1.40, so the hesitation zone would be 75 pips below $1.40, and the end of the hesitation zone would be $1.3925. Now, let me take you to the previous slide. Remember the prices here moving above $1.4250? What was the first thing that we can notice when we compare both of the price behavior and activity of the euro-dollar pair around these large quarter points? They move above $1.4250, but they only move about 31 pips. Do not target the end of the hesitation zone, come short ahead of the whole number at the $1.43. And then they reverse back to the large quarter point and break below that large quarter point. What is the difference here? Prices break below a large quarter point at $1.40. They move decisively. Here's the question that was asked earlier. Is the answer. They move decisively below $1.40, further into the hesitation zone. They reach the end of the hesitation zone right here. And then the second part of what a trader must pay attention to. Do prices remain within the new quarter that they've entered on any price pullbacks? On a pullback, let's take a look here. What happens? Prices move back. It is normal for prices to move back to the preceding large quarter point. Do they stay below it? The answer is yes, they do stay below. And that's a very important second factor that lets us know that this time around, the large quarter transition is successful. And what that means also, if prices move to the end of the hesitation zone, on pullbacks they stay below that large quarter point at $1.40, that is a sign that the euro-dollar pair could make further advancements into the new large quarter. You have to remember that just because prices begin to work on a large quarter or they enter a large quarter, that doesn't mean that a large quarter will be successfully completed. That move of 250 pips from one large quarter point to the targeted next large quarter point is going to be successfully completed. Those are some of the factors that we need to watch for in order to find out, do we have a greater probability for prices to make further advancement into that new large quarter? And here's your other important price level within the large quarter, and that is the exact half point. Of the large quarter, which is the exact half point between the two large quarter points. Again, this is a constant, never changing level because the quarters are constant 250 pip ranges. The exact half point of each quarter is exactly 125 pips from each one of the two large quarter points. And what we can anticipate, if prices enter the hesitation zone, move to the end of it, pull back, and on pullbacks remain below that large quarter point, the next level that we could target, we can expect further advancement into the new large quarter. And the next level that we can target is the half point of the quarter. That means further advancement into the quarter, beyond the end of the hesitation zone to the half point. Now, when the prices reach the half point, if they pull back to the large quarter point, which they do over here, if prices continue to stay below the large quarter point, then we can anticipate for them to continue even further into the large quarter. and ultimately challenge another important level, which is the whole number preceding a large quarter point. In this case, that was the $1.38 level, and then ultimately produce the successful completion of the large quarter targeted at the $1.3750. Now let's take a look at the recent developments with the pound dollar pair. Now you are going to see that the numerical representation of the large quarters is going to be different. There will be different numbers here, but the ranges are exactly the same. They're identical, no matter whether the numbers are different that represent the large quarters or the cavitation zone and so forth. In a pound dollar pair example, in the hours and days before the Fed's interest rate announcement, the price activity, the prices are settling around another very important major large quarter point. With the euro dollar pair, that was $1.40. With the pound dollar pair, that was the major large quarter point at the $1.60. Again, the numbers are different, but the ranges are the same, constant. With the Fed's interest rate announcement serving as a catalyst, the pound dollar pair challenges its own resistance levels, which were a little bit above $1.61. And after ahead of the interest rate announcement even, the pound started to break higher against the US dollar. This is the Fed's reaction, the hour in the aftermath of the Fed's announcement. And ultimately, the Fed serves as a catalyst for the pound dollar to strengthen versus the US dollar as well, breaking above these previous resistance levels and, surprise, surprise, producing a successful completion of the large quarter between $1.60 and the targeted large quarter point above, which is $1.6250. Just as the euro-dollar pair, on a leftover of that massive strong push to the upside, which also I call inertia, if you will, the pound-dollar pair moves a little bit above the large quarter point at $1.6250. It manages to reach a high just a little bit ahead of the whole number, which I made a mistake here. The whole number was $1.43 for the euro-dollar pair. This was $1.63 for the pound-dollar pair. Okay? Different numbers, same idea. Prices enter the hesitation zone 75 pips above the large quarter point at $1.6250. The end of the hesitation zone in this case would be $1.6325. But just as the euro-dollar pair, they do not reach the end of the hesitation zone. They stop short of that whole number at $1.43, which in itself is an area is an important level within the hesitation zone that could attract a lot of traders, but could also cause a resistance to be encountered there. And then prices move back to the preceding large quarter point, drop a little bit below it, make another attempt to break into the new quarter, never break outside of the hesitation zone, do not break above that resistance, and then ultimately reverse back to the large quarter point at $1.6250. And then this time around, instead of just overshooting that below $1.6250 by a few pips, this time around they make a decisive move to the end of the hesitation zone, which below $1.6250, the end of the hesitation zone would be $1.6175. This is an example. After that, they of course pull back to the large quarter point at $1.6250 and then overshot it. Two-digit currencies, same thing. I will show you, by the way, that's a question coming from a listener. I'll show you an example with dollar-yen pair in just a few minutes. So this is an example here of what I call the dual hesitation zone play. Prices enter the hesitation zone above $1.6250, pull back, break below the large quarter point $1.6250, enter the other hesitation zone below that large quarter point, move back to it, break above it a little bit, enter the other hesitation zone, and that's an indication also that we don't have a very decisive type of a trend development here, if you will, as well. One of these hesitation zones will have to be broken. Prices would have to get outside one of these hesitation zones in order for a trader to recognize more decisive sign, if you will, and a move that would be a signal that that the market's basically made up its mind, if you will, in some simple terms to put it, as far as which quarter the market is more willing to work on. The quarter above $62.50 or the quarter below $62.50. These dual hesitation zone fluctuations gives you an idea of the market's indecisiveness. But as the time goes by, and of course risk aversion starts kicking in, which hurts the British pound, we get to see the moves into the hesitation zone above $62.50 being much smaller as far as number of pips are concerned than compared with the moves in the other hesitation zone below $62.50. So when prices break below $62.50 again, they once again make a further advancement to the end of the hesitation zone at the $61.75. We see a small pullback during which this time prices do not break above $62.50. And then of course we get to see the further advancement into the new large quarter to the, surprise, surprise, the half point of the quarter at the $61.25. Look at all the price activity here that's happening around $61, also because of the previous resistance, of course. Then ultimately, on any pullbacks, prices do not break above $62.50. They remain firmly within the new large quarter. And then after the support at the $61, which was the previous resistance, on the way down, of course, establishes itself as a level support. That's the reason for all this testing of the $61 area. And ultimately, on a third or fourth, fifth attempt even, we get to see the break below $61 and then ultimately the successful completion of the large quarter at the $1.60. And not only a move to $60, but also we had some support here from last week at the $59.60, which by the way was challenged. Not a coincidence if you paid attention to the latest developments for the pound-dollar pair, finding support in the vicinity of that area, $59.60. I believe it reached as low over here, that was yesterday, at the $59.50, overshot below $59.60, but 10 pips, not a decisive breakout. Again, my rule of thumb is to see a move that's more than 25 pips in order for us to consider a price move as a decisive breakout, and then the pound finds support, climbs back above $0.60, and on its way, I think today it reached as high as $61 something, a little bit short of $0.62 area. So this is an example, again, with a different currency pair, different price levels. Yes, of course, there is a hesitation zone after prices broke below $60, find support at the $59.60, enter the hesitation zone below $0.60, never broke outside of it, found support at the $59.60, came back into the previous quarter, and now start working on a quarter in recent day, working on a quarter above $0.60, between $60 and $62.50. They exited the hesitation zone successfully yesterday, if you recall, moving higher to almost $62, which is the whole number preceding the large quarter point at the $62.50, and we'll find out if the quarter is successfully completed in later on today or in an upcoming trading session, which we only have one trading session this week left, tomorrow, before the weekend. And I'm not going to have time to discuss the 3-day rule of the quarters theory, but very quickly wanted to mention that the quarters theory, the time stop rule is that I allow a major currency pair 3 days or 3 24-hour trading sessions on foreign exchange markets for a currency pair to complete a large quarter. If a quarter is not completed in 3 days, then that could serve as a time stop for a currency trader to prepare for potential reversals. Because, as I will show you right here, the unsuccessful completion of a large quarter has its consequences. Here's an example with the Aussie dollar exchange rate. ahead of the Fed's interest rate announcement, the dollar parity level there, 1 for 1, 1 US dollar for 1 Australian dollar, is being approached, challenged, overshot by 2 pips on October, I don't remember exactly the date, where the Aussie dollar pair reached $0.0002, only 2 pips above parity. With the Fed's interest rate announcement right here, we have a decisive breakout above the large quarter point at $1, an entrance into the large quarter, which is decisive entrance, to the end of the hesitation zone, 1.0075. Pullback on the pullback, prices do not break below the large quarter point at $1 and then continue further into the large quarter. But as I already mentioned earlier, just because prices work on a large quarter decisively, and they do enter a large quarter decisively, that doesn't mean that a large quarter will be successfully completed. So we always have to be on the lookout for signs of weakness and potential exhaustion that could signal unsuccessful completion of a large quarter. And not to worry, as a result of that, we also know what is the next move that we can anticipate. In most instances, the unsuccessful completion of a large quarter leads to exhaustion and a reversal that takes prices back to a preceding large quarter point. In the case of the Aussie dollar pair, we had a decisive entrance, further advancement into the large quarter. But what I call the last problematic price point, the whole number preceding a large quarter point, in this instance served as an area of resistance and prevented prices from continuing further and ultimately completing the large quarter to the targeted large quarter point at the $0.0250. In this instance, it was the $1.02 level, which is the whole number preceding the large quarter point. As I said, this is the last problematic price point within a large quarter that could prevent the successful completion of a large quarter. In this case, the Aussie dollar pair goes as high as $0.0182, wasn't it? Or something like that. Just a little bit ahead of the whole number at the $1.02. Encounters resistance there. You're seeing these several attempts to continue further, but you can spot the signs of exhaustion right there. And then ultimately, prices reverse back to the preceding large quarter point, which was the large quarter point at $1. Okay? Have a couple of minutes before I finish the presentation. I'm getting a message, so let me quickly cover the latest developments with the dollar against the Japanese yen. Dollar against the Japanese yen, a lot of you know, we witnessed an intervention on September 15 from the Bank of Japan. The intervention low was 82.81 yen. The dollar-yen pair spiked, came short of 86 yen level, and then slowly but surely, day after day after day, started grinding lower and lower to ultimately complete a couple of large quarters. Those were the quarters between 85 yen to 82.50, and then 82.50 to the large quarter point at 80 yen. On November 1st, prices reached as low, depending on what charting platform or data feed you're using. I have several. One of them, the quote was 80.23, others was 80.25. As long as prices, see, what we do not ask from prices is to reach a targeted large quarter point exactly after the pivot. So as long as they reach within the vicinity of one small quarter or 25 pips from a targeted large quarter point, then we consider that large quarter as completed. So as long as prices reached on November 1st a low of 80.24 or 80.23 within 25 pips from the targeted large quarter point at 80 cents, we consider that large quarter as successfully completed. And then ultimately, they never broke below the large quarter point at 80 yen and then reversed higher, with the dollar taking advantage of the opportunity to produce a little bit of a more significant price correction against the Japanese yen. Of all these losses from below 86 yen to almost 80 yen, we're now seeing a move to where, surprise, surprise, the large quarter point at 82.50, and then because the September 15 intervention low was 82.81, Yesterday we even reached as high as 82.79, only 2 pips below the previous low, which now obviously served yesterday as a level of resistance. So I'm running out of time. I appreciate you for joining me today. Thank you very much for your interest in my quarter series. And of course, if you would like to learn more about the quarter series, you can pick up my book, The Quarter Series, available everywhere, or listen to my daily broadcast, Monday through Friday, 1 to 2 p.m. Eastern Time. Thank you very much for attending today. Thank you to our friends from fxstreet.com for putting up the presentation. And I'm looking forward to seeing you again